Good day, everyone. Welcome back to this course, Introduction to Financial Accounting 1. Today we are looking at the last and final chapter of this course, which is Chapter 9. So let's take a quick look at the learning outcomes that we want to cover for today in the following slide. Let's get started. As you can see in this chapter, the textbook covers 9 learning outcomes for this chapter, the chapter that covers accounting for receivables. For us, for the purpose of this course, we are only going to take a look at the first 3 learning outcomes. So we will try to identify the different types of receivables. We want to explain how companies recognize accounts receivable. And finally, we will try to distinguish between the methods and bases companies use to value accounts receivable. So let's start with the first learning outcome. So what are receivables first? Receivables are amounts due from individuals and other companies that are expected to be collected in cash, typically within 1 year or one uh, accounting cycle. And receivables may come in 3 main types. The first one is accounts receivable, the account that we have dealt with previously, and we have recorded transactions under this heading. And these represent amounts owed by customers that result from the sale of goods and services. The second type is notes receivable, and this represents claims for which formal instruments of credit are issued as proof of debt. And we said that typically this is a short-term debt for small amounts normally. And the third one is other receivables. This includes multiple other accounts such as non-trade or interest loans to officers, advances to employees, and income taxes refundable or rebates and other accounts of such a type. Now, depending on the type of activity that the company we are covering uh, operates in, uh, we can see a variance between different companies that operate in different sectors. When we look at the receivables as a percentage of their total assets, so you may get companies such as General Electric here in the data in front of you that have receivables that represents 52% of their total assets. And you might have companies that have a higher percentage, and you have other companies such as Intel Corporation here only has 5% of their total assets in receivables. We have included some Saudi companies here or local companies, their uh, receivables percentage as a percentage of total sales. We have Wiley with 8%, Nama Chemical with 4%, and Sabic with 6%. This data is a little bit old, might be outdated, and this percentage may change, of course, over time. But uh, we provide this data as a reference point, just to show you that depending on the activity of the company, uh, there might be a variance of how much receivables they have as expressed as a percentage of their total assets. Now, if you remember from our studies we covered previously, I have mentioned to you guys multiple times that receivables accounts are temporary accounts that we typically close them once we collect the payments. But sometimes we don't collect the payment, so we're still gonna have to close these accounts one way or the other. So looking at receivables from an accounting perspective, we might consider 3 factors or 3 issues that we need to take into consideration. The first one is recognizing these accounts receivable. The second one is valuing these accounts receivable. And the third one is disposing of these accounts receivable. So let's start with recognizing accounts receivable. when we want to recognize accounts receivable, these accounts receivable may result of a service that we provide to our customers or as a result of selling some products to our customers. So for service organizations, they record the receivable when they provide the service on account. So they deliver a specific service to one of their clients, and that service is not paid for right away, so they have to recognize an account receivable in order to collect the payments at a later date. Now, for retailers or merchandising companies, they record accounts receivable when they sell products on account. So they deliver specific products to the customer and the customer does not pay right away, then they're going to have to recognize an account receivable for that sale transaction in order to make sure they collect the payments at a later date. How do we record the recognition of an account receivable? Well, we've done that so far in multiple exercises, but here we have an illustration. So let's go over this one pretty quickly. This one says, assume that um, Jordan Company on July 1st, 2012 sells merchandise on account to Polo Company for $1,000, terms 210 net 30. Prepare the journal entry to record this transaction on the books of Jordan Company. Now they have provided a product, or they sold a product, but the payment is going to be collected at a later date. If you guys remember, how do we record such transactions? We debit accounts receivable and credit sales revenue. So this is what we've done here. So on July 1st, debit to accounts receivable account for $1,000 and a credit to sales revenue account for $1,000. You may also remember how do we handle or how do we record if the customer that purchased those products from us returns some of these products. We've covered that in chapter 5. So here it says on July 5th, Polo returns merchandise worth $100 to Jordan Company. So we're gonna simply just record a debit to sales returns and allowances for $100 and a credit to accounts receivable of $100 since we want to reduce the amount that we are going to ask this customer, in this case Polo Company, to pay us in the future, right? And then on July 11th, it says Jordan receives payments from Polo Company for the balance due. Now in this case, the balance due is only 900, right? Because they purchased products from us for 1,000, then they've returned some of the products worth 100. So the total account balance, accounts receivable balance, if we look at the ledger of the accounts receivable account, we're going to see only 900 that relate to Polo Company that we should collect from them, right? And since they are paying within the allowed period for the discount, so they're going to get a 2% discount on that 900. So just like we used to do in chapter 5, we're going to debit cash for the $900 multiplied by 0.98, which is the 100% minus the 2% discount. So that will give us $882. And we're going to also debit sales discounts for the 900 multiplied by 2%. In this case, it's $18. And we're going to close the accounts receivable by crediting the account for the 900 that we require from Polo Company. Now let's move on to the second issue, which is valuing accounts receivable. Now, accounts receivable are recorded in the balance sheet under the current assets section. And typically they are valued at the net realizable value, meaning that depending on the total of the amount under the accounts receivable balance, the accountants, one way or another, need to estimate how much of those accounts receivable are actually collectible, meaning that can be collected in the future. If not, then they're gonna have to remove those accounts receivable, right? Because they cannot consider them or continue to consider them as assets, right? They will be considered as losses. So the sales on account raise the possibility of accounts not being collected. So when you sell something and you receive the cash right away, that's fine, that's great. But sometimes when you extend credit, the the customer that you extend the credit to may not be able to pay for one reason or another. So what do we do as a company in that case? As a seller, we record the losses that result from extending the credit as bad debt expense, right? Now, how do companies show on their financial statements and on their records that some of their accounts receivable are uncollectible? They have two methods. The first one is the direct write-off. Now, this one is not really in accordance with GAAP, so we don't really focus much on this one. But uh, the problem with this is that it doesn't really provide a much of a matching between the amount of accounts receivable uh, that you have and the amount that is uncollectible, and the receivable is not stated at cash realizable value. So for that, it's not really acceptable for financial reporting. Um, the the way that is recommended for reporting uncollectible accounts by GAAP is to create an allowance. So this is called the allowance method. So for this method here, the losses are estimated, which provides better matching, and the receivable stated is going to be stated at cash realizable value on the financial statements of the company. So now let's take a look at a step-by-step how are these accounts presented on the balance sheet. Here in front of you, you see the ledger accounts for the accounts receivable account and the allowance for doubtful accounts. And we are assuming an opening balance of 500 debit to the accounts receivable and a $25 credit to the allowance for doubtful accounts. So let's move on with this example step by step and see how do we represent um, these or how do we create these allowances and how do they present them in the balance sheet eventually, because that's the main purpose. Now, based on the beginning balances that we had in both the accounts receivable account and the allowance for doubtful accounts you saw in the previous slide, this is how it's going to look like on the balance sheet. Now, of course, this is a snippet. This is just a partial balance sheet that shows the current assets. And as you can see, we have the accounts receivable account and the allowance for doubtful account, which is an asset collateral account. That is why we are subtracting it from the accounts receivable account. So we have 500 under accounts receivable, and we have $25 under allowance for doubtful accounts, which gives us a net $475 accounts receivable that is collectible. This is another way to present the same information we mentioned in the previous slide. Instead of two lines, here we are using only one line. So we're just including accounts receivable, net of 25 allowance. So we're basically combining the two lines from the previous presentation into one line only. And of course, the same data is reflected. Let's assume we made a new credit sale of $100. The journal entry in that case, of course, is going to be a debit to accounts receivable of 100 and a credit to sales revenue of 100. Now we also need to, of course, post that into our ledger accounts. So here we post the debit to the accounts receivable account of 100 under the accounts receivable ledger on the debit side, as you can see, and we add that to the beginning balance of 500. So now we end up with a balance of 600 accounts receivable. And here the example assumes that the company have collected $333 in cash from those accounts receivable. So of course, once we collect that amount, we're going to debit cash and credit accounts receivable. And of course, we're going to post that change into our ledger accounts correspondingly. So we're going to go to the accounts receivable ledger account and post the $333 collection on the credit side of the accounts receivable, which adjusts our accounts receivable balance from $600 down to $267. Now the example also expands this and uh, asks you to adjust for $15 for estimated bad debts. So in order to do that, you're going to have to debit bad debt expense account for $15 and credit allowance for doubtful accounts for $15 as well. And of course, posting that entry into our ledger account here, the allowance for doubtful accounts is also going to be credited for $15 that we posted from our previous journal entry, which brings up the balance for this account to $40. Now, what happens if a company exhausts all of their uh, possibilities trying to collect that money and they're not able to? Well, they decide to write off that amount of their books. So to write off a uncollectible account, they are going to have to credit that amount to accounts receivable and debit the allowance for doubtful accounts for that write-off amount. In this example here, we have a $10 write-off that this company decides that is not that it is impossible to collect. So they're going to debit allowance for doubtful accounts of $10 and credit accounts receivable for that same amount, and of course post these into the appropriate ledger accounts. So from the accounts receivable balance and the allowance for doubtful accounts balances that we had in the previous slide, you notice that we had a debit to accounts receivable of $257 and a credit to the allowance of doubtful accounts of $30. So ABC's corporation balance sheet is going to look like this. We're going to have a line for accounts receivable net of $30 allowance. So that is going to be $257 minus $30. That will give us $227. Instead of creating an allowance, we could also directly write off that uncollectible amount, but as we said, that this is not in accordance with GAAP, so it's not really allowed for standardized financial reporting. But for the sake of learning, let's just look at this quick example. It says assume that Warden Company writes off M.E. Duran's $200 balance as uncollectible on December 12th. Warden's entry is going to be bad debt expense or a debit to bad debt expense of $200 and a credit to accounts receivable. So as you can see, there was no allowance created. The amount was directly debited to bad debt expense and deducted from the balance of the accounts receivable. So to summarize the allowance method, it begins with the company estimating the uncollectible accounts receivable. Now, companies typically estimate the amount based on the as a percentage of the accounts receivable or as a percentage of total sales, and then they debit bad debt expense and credit allowance for doubtful accounts, which, as we mentioned, is a contra asset account, and then they debit allowance for doubtful accounts and credit accounts receivable at the time the specific account is written off as uncollectible. Here we have another example. This one says Hampson Furniture has credit sales of $1,200,000 in 2012, of which $200,000 remains uncollected at December 31st. The credit manager estimates that 12,000 of these sales will prove uncollectible. So because of that, we're going to debit bad debt expense 12,000 and credit allowance for doubtful accounts for 12,000. And of course, that is going to be reflected and on the company's balance sheet as follows. We're going to have a line for accounts receivable, of course, for the $200,000 that remain uncollected at the end of the year. And we're going to subtract the allowance for doubtful accounts we have, or the account manager have estimated of $12,000. So that's going to give us a net accounts receivable of $188,000. The next stage here says the Vice President of Finance of Hampson Furniture on March 1st, 2013. As you notice, is about 2 months later. Uh, he authorizes a write-off of the $500 balance owed by RA, where the entry to record the write-off is going to be as follows. So, in that date, one of the customers that are included or that we require payment from, the Vice President of Finance decided that this particular customer is not going to pay for one reason or another. So they decided to write off the amount that this particular customer owes to the company, to Hampson Furniture. So they are going to debit allowance for doubtful accounts for 500 and credit accounts receivable for 500, just like we've done in the previous example. So posting those, as you can see, is going to result in a reduction of the accounts receivable balance from 200,000 to 199,500, and it's going to also reduce the allowance for doubtful accounts from 12,000 down to 11,500. So basically, we're eliminating this portion of the balances, which is represented by the $500. Now, in some cases, after a company decides to write off a specific uncollected amount, we might receive that payment at a later date. This is the case that happens here in this example. It says on July 1st, RA Ware, same customer that we have decided that he is never going to pay, pays the $500 amount that Hampson had written off on March 1st. Hampson makes these entries. Of course, in that case, what we need to do is we're going to need to reverse the write-off entry that we made before. So when we written off the amount, we have credited accounts receivable and debited allowance for doubtful accounts. What we're going to do now is we're going to reverse that. So we're going to debit accounts receivable and credit allowance for doubtful accounts for that 500. And then we're going to record another entry to reflect that we had actually received the money. So we're going to debit cash 500 and credit accounts receivable for that same amount. Now, in order to estimate the allowance, as I have mentioned before, the company needs to take a decision. So they could either estimate the allowance as a percentage of sales or as a percentage of receivables. Now, both bases are generally accepted, and the choice goes back to the management, and it depends on the relative emphasis that the management wishes to give to expenses and revenues on the one hand, or to cash realizable value of the accounts receivable on the other. Now, the choice is whether to emphasize income statement or balance sheet relationships. And as you can see in the illustration here, the percentage of sales basis results in a better matching of expenses with revenues, which is an income statement viewpoint, and the percentage of receivables basis produces the better estimate of cash realizable value, which is a balance sheet viewpoint. So under both bases, the company must determine its past experience with bad debt losses. So typically they base their estimation on historical data to try and be as accurate as possible. In the percentage of sales basis, the management estimates what percentage of credit sales will be uncollectible. Now, this percentage is based on past experience or historical data, as I mentioned, and anticipated credit policy. So the company applies this percentage to either total credit sales or net credit sales of the current year. As an example, let's take a look at this illustration here. Assume that Gonzalez company elects to use the percentage of sales basis. It concludes that 1% of net credit sales will become uncollectible. If net credit sales for 2012 are 800,000, the adjusting entry then is going to be a debit to bad debt expense of 8,000, which is 1% of the credit sales of that year, and a credit to allowance for doubtful accounts for that same amount. And as I have mentioned earlier, this method emphasizes matching of expenses with the revenues, which is an income statement viewpoint. Also, adjusting entry to record bad debts disregards the existing balance in the allowance for doubtful accounts ledger account. On the other hand, under the percentage of receivables basis, management estimates what percentage of receivables will result in losses from uncollectible accounts. The company prepares an aging schedule in which it classifies customer balances by the length of time they have been unpaid. Because of its emphasis on time, the analysis is often called aging the accounts receivable. And the way this is done is illustrated in your textbooks in illustration 9-8. Based on the opening story of the chapter, you can see an aging schedule um, as copied here. This shows the customer balances where the company classifies them by length of time they have been overdue or unpaid, right? So as you can see here, this particular company has about 5 main customers and some other customers as well. So they've broken down the customers into 6 groups, and with the total amounts that they owe the company, and then they classify them based on uh, multiple categories. Are they due yet or not? So we have the first column, not yet due. So these show the amounts that uh, are not yet due. And then we have amounts that are due already but overdue. So the customer is already late on that payment. And of course, they also classify these into multiple groups. This company in particular chose to break them into 4 groups, so from 1 to 30 days overdue, so 1 month, and then 31 days to 60 days, so 2 months overdue, and then 61 to 90 days, so basically 3 months overdue, and then over 90, so amounts that are overdue more than 3 months, right? And they assign a percentage of uncollectible or estimated uncollectible amount. And as you can notice that this percentage of estimation increases with the um, with the passage of time. That's why we call it aging schedule. So the more the amount is overdue, or the longer the period the amount is overdue, the higher the chance that this particular payment will not be collected, right? And then they, of course, total these amounts and decide how much is the total uncollectible accounts based on this aging schedule methodology. Here we have an example that says assume the unadjusted trial balance shows allowance for doubtful accounts with a credit balance of $528. Prepare the adjusting entry assuming $2,228 is the estimate of uncollectible receivables from the aging schedule. Once you get that piece of information collected, then you can simply just debit bad debt expense with the amount of 1,700, which is the difference between the two amounts, and then credit allowance for doubtful accounts for 1,700. As you can see in the bottom in the illustration, these amounts are posted into their appropriate ledger accounts. That's it for the key points covered in this chapter. I hope you guys have enjoyed it. Thank you so much for listening, and I hope you enjoyed this course that we have covered together. And as always, of course, if you have any questions, please feel free to ask down in the comments section. Thank you guys for joining me. I'll see you in the next one. Take care.